don't let their rule of thumb lead you to check something off that's not actually reviewed.
Yeah.
And because you're probably going to have the situation where you do end up overpaying in taxes. This is Successfully Retired with Hamilton Brandenburg.
This is a good one. This is one I've been talking about on social media a lot, but never really sat down and talked to you on camera about. Are your taxes going to be lower in retirement? Yes or no? And is that what you're basing your whole investment and tax strategy around? This is something that I it's like a known thing.
Yeah.
This is just how people say it. As a matter of fact, your taxes will be lower in retirement, and that's how they make their determination on how they're investing, if they're doing IRA and all that sort of stuff. Let's unpack that a little bit
Unless
because
they're
that's
trying
not
to
been
sell
my
permanent
experience.
unless they're trying to sell permanent life insurance as a retirement vehicle, then like, no, your taxes are gonna be 900% in retirement.
Right, I
Right.
know.
No,
But but is that that's what people are being told,
yeah.
not just not by advisors, by their coworkers, by their parents, by their accountants,
That's what I wanna bring up point.
CPAs.
So,
Yeah, so let's
I knew
unpack
an
that a little
accountant
bit.
once. I knew an accountant once, and, nice person, and was helping her out a little bit with some stuff, and then I was helping, her son set up an account and get started. This is, like, my first year as an advisor, and I had kind of did my whole discovery with him. Okay, your cash flow, your needs, whatever. We're gonna set up automatic deposit into a Roth and a taxable brokerage account for you. And she
Mhm.
just like immediately, she's like, no, don't do the Roth. Do the traditional IRA because your taxes will be lower in retirement. Boom,
Yeah.
move on, order entrees. And
Yep.
that really rubbed me the wrong way for a couple of reasons. But one is like, first of all, how do we know that everybody's taxes are going to be lower in retirement? But two, there's that's not like the main reason to do a traditional IRA over a Roth. And I'm not even going to go down
Right.
that rabbit hole right now about
Right.
flexibility and withdrawing contributions along the way because most 20 something year olds that I know who start a retirement plan end up cashing out some portion of it at some point in time in
Yeah.
their life. But yeah, this whole myth of like, hey, everything should go into pre-tax because your taxes are going to be lower in retirement. It's really banking a lot on the future, and a lot of stuff can lead to your taxes being higher in retirement. Not
Yep.
just the tax code, not just the fact that,
No.
not just the deficit, not just Congress and Washington D.C., but I mean, what are some things that I know you and I've talked about this, and I've got one couple in my
Yeah.
pocket. But what are things that you have seen drive people's tax bill higher in retirement than it was beforehand, or at least the same? Like, what are your thoughts on this?
The very thing that got them there in the first place, which was all the pre-tax
Yeah,
dollars.
yeah,
So like that concept comes from like back in the day, like all these rules of thumb that are coming from your parents and your grandparents were because things were different, right?
yep,
They were different. This move to bonds as you get closer to retirement. Things were different. This taxes will be lower in retirement. Things were different. So yeah, if you plan on retiring with like $100,000 to your name, probably taxes will be lower for you.
sure,
Awesome. Not a whole lot of planning opportunities there. If you're going to put some zeros behind that, you're likely going to be in a very similar tax situation because all of your dollars are now taxable. So, unless you plan on living poor and not enjoying your first 10 to 15 years of retirement and
yep,
not spending any money, you're going to be pulling out dollars that are taxable, which creates the taxable bracket.
yeah. I'd
The
say
other
it's
thing
based
is,
on that whole mentality is based on rules of thumb, right? There's
yeah,
nothing wrong with rules of thumb.
for people that don't have any money,
Yeah, well, yeah,
it works. It works if you, I mean, seriously, I'm not trying to be a jerk, but it works if you don't have a lot of money
yeah,
because it's like I put a dollar in and I'm paying 12%. And when I retire, I take the dollar out at 0 or 10%. Cool.
yeah.
Great. But we're talking about people that are 24 or 32 and they're coming out and they still want to spend 100 grand or more when they're retired.
Well, it also assumes a big, huge, drastic drop in income in retirement, which is not always the case. To your point, you talk about young people wanting to spend a lot in retirement. There are also a lot of people who, if the I mean, the market's been great for the past couple of decades.
Yeah.
It's been gangbusters. And you get a lot of
Yeah.
folks, I know we've talked about them who have just invested in their 401k in all stocks and not really paid attention to it. They just take the pay raise and put a little bit more in the 401k. Well, now they're in a position where they can afford to actually spend more money in retirement than they
Yeah.
could have beforehand. And
Yeah.
that's something that I think is not intuitive to a lot of people. They don't realize, hey,
The
sometimes you can actually
the
match your cash
majority,
flow.
yeah, I mean, the majority of the people that I work with are that, like, middle class millionaire
Sure.
that likely can spend more now than they were actually earning
Yes.
when they were working, just because they've saved, they live within their means, they own their home, all that. They did all the right things, and they didn't either understand or expect to get double digit returns for the last 15
Yep.
years. And all of a sudden they're looking at all this money. And here's the other thing, which is kind of goes hand in hand with walking out of work on your last day with this really big IRA,
Yep.
is not only do you want to start spending it, and you should, which creates taxable income and puts you in a similar place to where you were working, but you also want to get out from under it as soon as
Yep.
possible, which is like literally, if nobody had an IRA, we'd probably have to lower our fees. How much work do we just did a thing about Roth conversions. Like, one of the biggest value adds we do is tax planning around Roth conversions and threading the needle between health insurance premiums and Medicare surcharges and all that sort of stuff, and do these Roth conversions. The only reason that is because these people come out of work with huge IRAs and don't want them anymore
Yeah.
because they have no flexibility. They get taxed on every dollar, and every time they take a dollar out, it affects something else around them. And they finally realize what's going to happen to their surviving spouse and their kid
Yep.
when they pass away.
Yep. 100%. Yeah, that's it backfires in a lot of ways. Now, I mean, you got to think the Roth IRA wasn't even started until like late
Right.
90s, 97.
Right.
So, like, barely older than my youngest brother. Like,
Yeah.
come on, it's
Yep.
it's it's pretty new development. But I think a lot of times people who think they're if you assume your taxes are going to be lower in retirement, and you just invest everything into your pre-tax 401k or an IRA, it's probably going to backfire on you, right? You
Yeah.
probably should be putting some money into a taxable brokerage account. You probably should be putting some money
Yes.
into a Roth IRA or Roth 401k.
Yeah.
You might have to do a little bit of work to figure out how much goes into which, or hire somebody, but
Yeah.
that will probably optimize things. But if you don't, what are some of the ways that you and I have seen this backfire on people? And I know you kind of started alluding to it, but like, how does this
Yeah. I
actually
mean,
bite you in the butt?
I come out, I have my social security, maybe a small pension, maybe not. Um, I've got some cash, all these other things, and I have this million or $2 million IRA. I want to start spending money. And here's the other thing. Not everything is divided by 12,
Yeah.
divided by the years you're going to live. I want to take $70,000 out and fix up our cabin that I've been wanting to do for a long time. I want to take the family on a big vacation, but also have to cash flow me for the year for the bills. So it's like double the amount. Like, I want to take money out. You're telling me I have more than I need. I want to spend it.
Yes, which is a good thing.
And if every dollar comes out as taxable, it creates other problems. It's going to increase your health insurance if you're pre 65. It could increase your Medicare if you're post 65,
I don't know
right?
like a single retiree that I've worked with that hasn't wanted to do like a one-time pull for
Yeah.
something big. Sometimes it's 200K. Like literally, like
I've
the
been
best luck
thinking
that I've
about
had, like
this for 25
250.
years, and now I can
Yeah.
finally do it. And as soon as they do it, or they start thinking about it, they might not do the thing they've been thinking about for 25 years because they don't want to pay $45,000 in taxes
Yes, and in a lot of ways,
to
that's even
access the
worse. It's
money.
like, okay, now we're letting the tax tail wag the dog.
That's
We're
right.
trying to not pay taxes. We have sticker shock. We already talked about that, about
Yep.
something that's really important to us, and so we're intentionally not aligning our money and our values together.
Yeah.
So yeah, you can see if you lean all into this idea, it restricts your flexibility on
Yeah.
doing a big pull in retirement, because that's when people want to spend the most, is at 60 to 70, or if
Yeah.
you're lucky enough to retire in your 50s, that's when you're going to want to
Yeah.
have the most flexibility to spend. So I've seen the
So that
backfire that
that
way
just
for sure.
to kind of yeah, just to kind of clarify that though, like the concept is I'm working, I'm in 22% bracket. I put a dollar in my 401k, didn't pay tax, didn't pay 22% on it. I come out in retirement, I'm in 12% bracket. I take that same dollar out and I pay 12% on it, I save 10% in taxes. That's the concept. And it's okay as a concept. But what we're seeing in real life is the person puts a dollar in at 22%, it turns into $3,
Yeah.
right? And now they have to decide if they want to take 1 to 3 of those taxable dollars out in retirement or let it sit there and turn into
Yep.
6 and then be forced to take even more out, which is going to push them back up into the similar or same bracket that they were at before and reduce flexibility and all that other stuff. So it's just not that big of a tax savings for the people that are going to be in the 500 to $1 million or more mark in their IRAs
Yeah.
from what I've seen.
That's a really good point, and I think too, one thing that surprisingly not all financial advisors do, and probably not most of them do, but I know that you and I both do, is hey, if we have somebody who's retiring in the next 5 or so years, we're looking at what is the current tax bracket that their deductible contributions are going into these accounts at. So to your
Yeah.
point, let's say you're putting money into your 401k, and this is a true situation that's happened to me within the last year. Client was putting money into the 401k. They were getting a deduction of 12%, but they had done a really great job investing in that 401k. I mean, like a really great
Mhm.
job. When you look at what they were going to spend in retirement or what they could spend, they're going
Yeah.
to minimum be in the 22% bracket just to meet what they were capable of safely withdrawing very safely. So,
Yeah.
this is a conversation to have and say, okay, we are deferring taxes at a 12% high five here, but a 22% slap on the face here. And
Yeah.
not only is the rate higher, but the value of the investment has grown.
Yeah, there's more dollars.
Yes. And so
Yeah.
I'm kind of the opinion that I think a lot of times people like to optimize, like, okay, if your tax bracket is lower in
Yeah.
retirement, do the tax deferred. But I'm like, what's the actual dollar amount equilibrium? Like, maybe my
Yeah.
tax bracket's a little lower, but my investments have grown for 30 years. So I'm still paying a bigger tax bill
Yeah.
than what I got for the deduction going in.
What the pro pre-tax people will show you is, well, if you've put a I don't know how to frame it, but basically you put you're putting more in because if you put like if 10% was $1, your 10% is really only 80 cents into the Roth because you have to pay tax on it.
Sure.
But that's not a real life
No,
situation because people put 10% in their 401k,
they save what they're
not
going to save.
10% minus that. They don't calculate the tax difference. They just put it in.
Yeah. So you're talking about like,
The same amount of money's going in.
you're talking about people will say, if you want to save Roth instead of pre-tax, you have to save more to get the same
Yeah.
amount in. That is, if human beings were robots, that would be true. Human beings
Yeah.
don't optimize they don't we
No.
don't sit down and say, "Oh, here's the calculation. Oh, wait, I've got to change this to
No.
12% to off." No, this is what you do.
No.
You look at your paycheck, you say, okay, I think I can afford to do 10% of my 401k. I'm gonna, I don't know, half Roth, half pre-tax."
Yeah, right.
And you do it and you
That's
go
real
on and you
life.
say, that means my net paycheck is this much. Boom. And
Yeah.
you're done. People don't actually spend that way. They just save what they can save and they spend whatever's left over. That's another reason
Right.
why
So
people do.
so in real world,
Yeah.
you're likely putting the same dollars in, but the difference is when you get back to retirement, you can take more out
Yes.
of the Roth because you get to keep it all versus having to split 20 or 30% of it with the government. So it that argument I always kind of roll my eyes at because no one's doing that. No one's like putting less in the Roth because of having to pay tax on it. It just doesn't I've never seen that happen before.
Another thing that this is kind of funny, I've seen a lot of charts that show, you've probably seen this too, like financial institutions, financial advisors will be like the power of tax deferral. And they show this chart that says, okay, if you invested $100 in your 401k over time, or if
Yeah.
you invested $100 in a taxable brokerage account, you actually have
Yeah.
less money at the end from the taxable brokerage account because you had to withdraw money from it to pay taxes on the interest and the capital gains along the way. once
Yeah.
again, another classic example of financial
Never seen
professionals.
anybody do that ever.
No, they don't,
Never.
and I can tell you, I have a bunch of clients who direct deposit a big chunk of their paycheck into their taxable brokerage account, and you know what they never do? They never call me and say, "Oh, we need to withdraw 15,000 to pay the taxes on it this year." They spend what they can spend, they pay their
Yeah.
taxes, and what's left over after tax time and they've paid it, if they get a
Yeah.
refund, they spend that. If they don't get a refund, they pay the bill out of their savings and they, you know
In
what? Let's buckle down
fact,
a little bit more.
in fact, to your point, I just had this with a guy, and you know the backstory on it, but there was a lot of tax gain coming from another advisor that we spent a lot of time on strategically unwound.
Yeah,
Um, and just to soften the blow, because it was the right move for him, but just to soften the blow of the tax bill, I was like, listen, let's make the investments pay the taxes. It's their job
sure.
to pay the taxes. I did the tax plan. I'm going to set aside X dollars, which was a big number in cash. And then when the tax bill comes, I'm going to transfer it to you. But he was like, no way. I'm going to pay it out of cash
Yeah,
because I want the investments to keep growing. Like
yes,
that's our mental that's the correct mentality,
yes,
but that's how people are thinking. They don't take money out of their investment account that's growing to pay a tax bill when they have cash sitting there earning a quarter of a percent in the bank.
yes. I think the takeaway is don't let somebody's rule of thumb,
Yeah.
especially, and I don't wanna sound like a total millennial here, but, like, if somebody formulated all of their opinions about tax planning in 1994, several years
Yeah.
before Roth IRAs are even invented, and so many
Yeah.
tax bills have come out since then. If that's when they formulated all their accounting or tax expertise or opinions, and since then they've just had the same year of experience 25 times, don't let their rule of thumb lead you to check something off that's not actually reviewed. And
Yeah.
because you're probably going to have the situation where you do end up overpaying in taxes. And you could have just one small little tweak of diverting some money to a brokerage account or a Roth instead
Yeah.
could have
And
saved you a
listen,
lot.
this isn't like, and it's not a blanket, just do Roth and don't do the calculations, but likely unless you're a really, really high earner and have some other strategies built around that, I think the Roth is going to give you a lot more flexibility that you're not putting a dollar value on either, which is
Yep.
I don't have to deal with all this tippy toeing around my taxable income for my health insurance and all this sort of stuff because I have this big, huge bucket of tax free money.
Yep.
And one other thing that we didn't talk about because it's really a Roth conversion conversation and not for this, but it's all ties together. We always talk about a client taking required minimum distributions. If you don't know what that is, when you turn 75, which is the new age, the IRS makes you start taking money out of your pre-tax dollars, your IRA, your 401k,
Okay.
so that you start paying taxes. And we've done episodes about it. We're going to keep doing episodes about it because nobody understands. The smartest guys that I know, way smarter than me, have great jobs. When I say that to them, they look at me like I'm an idiot, like they've never heard of it, right?
Yep.
You and I call it the retirement tax bomb because it blows up when you're 75 and you don't have a choice. Something that we don't talk enough about and we should do another episode on is imagine what happens when you die,
Mm.
especially if you die early, and that retirement tax bomb goes off on your spouse who is now filing single
Yeah.
and has significantly lower brackets.
That's big. That's its own
Did you ever
episode.
think of
Yeah,
that?
no, that's huge. Yeah, and we've both seen that play out in real life. Widow
Yeah.
inherits money, husband did everything. All of a sudden, I have this big pre-tax 401k. Oh, and by the way, I'm
Your brackets are cut in
yeah,
half.
cut in half right away. I've
Yeah.
dealt with that
Yeah.
last year for several clients. No, that screws. Just
Yeah.
I'd say, yeah, keep the rules of thumb where they belong on somebody's radio show. Don't bring them into your personal financial situation,
That's right.
and
And and
don't
and
underestimate the value of flexibility on withdrawal strategies. And that's where
yeah,
the Roth and the taxable brokerage account, and I'd say the taxable brokerage account, highly
the
underrated,
best. Yeah.
is incredibly flexible. And it's really hard to put a premium on being able to do what you want to with your money when you're ready on your timetable. All right.
Yep, and I just want to close it with this thought, if anybody's still listening, and not to disparage anyone out there, but there's a difference between planning for and accounting
Yeah.
for. So, like, we are planning for the future and making decisions on what might be possible or what might happen in the future. Oftentimes, not always, but oftentimes, if you're paying a like a single small in the hundreds of dollars fee to get your tax prepared, they are accounting for what
Yep.
already happened. Those are two different things, planning for and accounting for. And often those relationships are built to success for them is the lowest tax bill today,
Yes.
not over your lifetime. And I'll just leave you
Yep.
with that. I think we should maybe have our own episode on that and kind of tippy toe around that concept. But for now, let's leave it
I
there.
like it. All right. Good talk, buddy.
All right, buddy. Thank you.
This show reflects the personal opinions and viewpoints of myself, Hamilton Brandenburg, and my guests. Opinions and viewpoints are subject to change at any time without notice. No representation is made as to the accuracy, completeness, or relevance of the information presented. The information discussed is general in nature and does not constitute investment, tax, or legal advice, so consult with your tax, legal, and financial professionals about your specific situation. Past performance does not indicate future returns, and any indices mentioned are for reference and cannot be invested in directly. Brandenburg Financial Services is a DBA of CS Planning, an SEC-registered investment advisor.